Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is December 2nd, 2022. S&P 500 currently sitting at 4051. I'm David Zong here with Ian Peter Pan McMillan, leader of the Lost Boys. Ian, we haven't been on here for a while because we took a little bit of time off to enjoy family over Thanksgiving. You have a good Thanksgiving?
I did have a good Thanksgiving. It was very good. How about you?
It was excellent. Are you a turkey guy?
Yeah.
Okay.
Are you not?
I'm kind of in the.
You like ham?
I love ham. I love brisket.
That's what you eat? Is that what you eat on Thanksgiving?
Well, we had this unique thing where my dad, bless his heart. So we have it at Paul's. For those who don't know, Paul's a managing partner here at Client First, but he loves hosting this. And there was like 40. Yep, my brother. We had 40 some people there. But we had this, we did have turkey, but there was also other meats there, like a roast or some lamb.
No fake meats, right?
No Beyond Meat junk.
Okay, good.
But I'm of the although the turkey that was prepared was pretty doggone good, but I'm of the ilk that turkey is the Nickelback of meats. And that's not a slam on Nickelback. I mean, some people really like Nickelback.
Turkey's like the Elton John.
Okay.
I think that's like a pretty consistent multiple generations Billy Joel.
Oh yeah, like U2, like
yeah,
Led Zeppelin.
Yeah,
you kind of have to have it.
I think it's a pretty consistent choice. So you don't do same thing at Christmas?
No, typically Christmas. This is different per family too. I know it's unique. So Christmas Eve is worship, and then we will have like heavy appetizers, some champagne after church, and open presents. And then there's one present that's saved for Christmas Day, and then there's families that do it different, right? We
eat and drink before Christmas Eve service.
Okay, that's fair.
Yeah,
that's fair. And then do you open presents at night, or do you wait till the next day?
Next morning.
Okay, so everybody's got their traditions, and I think that's great. As long as you're acknowledging the savior of the world, born for everybody. I love that part. But it's fascinating. I don't even know when Saint Nick's is, and I know people will do Saint Nick things this month, but I do really appreciate the family time that surrounds these things and taking time for Thanksgiving, things of showing thanks. And for example, Ian, you're one of the things I'm thankful for in my life. And I think it's important to step back and take that time. And I'm sure you spent time with family, we did too, and just appreciate the awesomeness of family, of loved ones. It's a good time here.
It is.
And we're thankful for those listening to this. And so we probably should talk markets. As much as we would love to talk different holiday meats, we probably should give them what they want.
Maybe we'll come out with a meats podcast.
That would be something.
We could have a YouTube channel.
We could. We could call it the Liver King. No? Okay. We're gonna talk markets. Where should we start?
So I don't know. Another so week in the major indices. We had a big move on, what was that, Wednesday? And so S&P got through its 200-day, first time since April 5th that it has been on the right side of its 200-day, still a downward sloping 200-day. So the long-term trend still down. And, even if this continues, it'll take, it's a 200-day. So it'll take quite a while for this to get turned around. So you can't really look at that, I would say, for anything short term. Russell 2000 to its 200-day also got there, now kind of petering around. I guess we've kind of been up there for a couple weeks. And speaking of 200 days, one that you and I mentioned a couple weeks ago, kind of the timing around these major indices was the dollars. The dollar got a nice bounce off of its 200-day moving average on Monday, but that has since
broken,
fizzled out, and now close to breaking this 104. Well, shorter term. So we have I guess 103, kind of the bigger.
103, 104 is that range in the trade weighted dollar using something like DXY that goes, all the way back to 2017. The full range goes all the way back to 2014, 2015. But your point is made, and it's an interesting dynamic because you have a rising. So when Ian says 200-day, he means 200-day moving average. So the prior 200 days of information averaged for the dollar itself on a trade weighted basis, it's rising, but price is now below that. Whereas the S&P and Russell 2000 are the 200-day is falling, and we've now met that average. So it's a reversion to the mean that we've seen since October. And I know, Ian, you did a great write-up last month for our clients, just talking about let's not miss the forest through the trees, and that a reversion or a counter trend move back to the 200-day doesn't necessarily mean that a bear market is over. It could be. We're not here to tell you whether it is or it isn't. But one step in that process would be to reclaim it and hold it. Is that a fair?
Yeah, one step. And it's a bigger step than we took in August at those highs where we got there and then kind of immediately petered out. Same with the Russell 2000. Now, there's still some overhead trend resistance, when we connect these tops going back to early January, January 4th, late March, mid-August, and then I would say yesterday. Still lower highs, still a lower low. And as we know, we don't know if it's a higher high yet until a new high is made.
Right. And a new high wouldn't be made, and something like the S&P would be above 4,300 would be a new high, and that would put us in a mixed type trend, right? Like putting yourself at a new price high that we haven't seen for a while would be an important step. But right now we're not really close to that. Now there's a thesis out there that we could melt up into there, but that's about 6% away. But your point visually about lower highs is that if you literally drew a line on a chart from January 4th, the high of the market and when I say high of the market, I mean something like the S&P. We haven't eclipsed that yet. Same with the 200-day. And so it's a return to the rate of trend being down at about 45 degrees from upper left to lower right. And until that changes, that's a downtrend.
Now, I would also say that this spot we have found ourselves at the last 2 days is a pretty 40-80.
Yeah.
40-80 area into 4,100. I think is a pretty big area. And we spent a lot of energy to get here.
Yeah, what do you mean? Like when you say energy, do you mean just from the standpoint of like since October 13th, we've moved about 16%, and
16. Even
and that's
through the
happened.
Highs, yesterday's highs, you were closer to 18%,
and that's in about 34, 35 days.
Yeah, exactly.
So it's a pretty
weeks at 18%. That's a big move. If we put August in context, that was mid-June to mid-August. So maybe 8 weeks, 19%.
Right.
So you could argue that this is moved, if we've got 6 weeks at 18%, that's 3% a week. August was 9. I mean, on a average move per week, it has been more dramatic than that, which is interesting. And I wanted to bring this kind of segues into another thing I want to talk about is I would say it's been a much different approach up to this rate of trend and this 200-day than we had in August.
Well, I can think of two things off the top of my head, but you go first if you.
Just the price behavior.
Right.
Of when you look at something like the S&P, a lot. I mean, both had big, grain candles. I would say this one was a lot choppier, and the ranges that it did build were, that early August range was much more tight than what we've seen since November 10th.
Well, and I would say that this rally off the mid-October low is really defined by 2 days, November 10th and November 30th.
Yeah.
Because really the move there was a 5% move on that November 10th, and then November 30th was about 3%. And so you had this positive November characteristic, which is seasonally in line, that we typically see stocks do well in November. And so it was good to see that from a bullish perspective. The other thing I would note that's different from different from the June to August rally is October. And forgive me, because I'm about to talk shop. It's about to be technical analysis, and usually we save this for the extended portion of the podcast. And so some may not be familiar with this, some will be. But the RSI, which is a way of measuring momentum, we did get oversold in September, which we hadn't since January of this year. RSI gets oversold, and now we're back to the 200-day, and we're not even close to RSI getting overbought like we did in August. The S&P was about 73, 74 as we entered the 200-day moving average back in August. At this point, we're not even in an overbought position. We're around 64 on the RSI. So it's less momentum in the market. And so it's an interesting dynamic because we've seen some breadth improvement.
I would say so. And there's still a lot of quality setups out there. I think that's one of the things, right? Then that, I would say we haven't had the stage 3, the October, November, December 08 type of move. I guess it was really kind of October-ish.
And when you say that, do you mean just
like the waterfall move?
Yeah, an accelerated move. You don't have to have it, like an accelerated move down.
And maybe, that is something comes later, but the more quality setups that continue to hold up, and, there's also the argument that I guess I use the word quality kind of, well, they are quality setups. Now, whether they behave accordingly afterwards has been a different story in 2022 and really 2021 as well.
When I think what you mean there, well,
but you got stocks moving higher. Individual stocks are moving higher, which if we're gonna get the waterfall, you would, that's gonna take 90-95% of stocks with it. And that's kind of the final third leg. Oh my God, the world is ending.
Well, the leadership group out of here, and if I'm allowed to put words in your mouth, and then you can spit them back out if it's not matching what you're saying, is so the leadership group that we've seen come out of here and good setups from our world, what we mean is you break to a new high and you hold that and you move higher. And what we've seen from the leadership group is, yes, they're in an uptrend. They may break out, but they don't hold that breakout. They dip they consolidate back into a previous price range, which some may interpret as a failed breakout, and then reclaims again. So there's a lot of there's a lot of overlapping uptrends, and it's coming out of areas that are not the big cap names. So out of this, what is
maybe
interesting,
liquidity thing as well.
Right.
It's hard to get a small cap train on the moving on the track when it trades 80,000 shares a day.
Well, that's an interesting.
Every move is, now 50 basis points, 75 basis points up and down. And these gaps, I'd say we've had a lot gappier approach on the S&P, going back to your point with November 10th. Versus what we had in August, June, July, August.
Right. And I would say off the October low, when we look at, okay, what's pushing that? What's making that happen? And we talked on here in the past about the leader, the big cap names.
Mm-hmm.
And so when we look at going back, it is some of those names that have let off the bottom. So another way to describe that is the things that let us down, meaning big cap tech has been the leadership to the downside. During this current rally is the leadership to the upside. And there's two ways to look at that. One would be, hey, it's great that the big cap tech names are back. But if you did your homework and looked at some levels, we're not out of the woods there.
No.
The other way to look at it is the garbage just rallied and it helped the market. And it's a two-way market because
big rally out of China.
Yeah, big rally out of China. But like you said, you've got individual names. But the individual names that might not have the market cap of something like a Google or a Microsoft.
Mm-hmm.
So it's a little bit mixed, and it's still within a broad environment that's lower highs and lower lows. What else? What else are we seeing from it? We could stay on stocks. We could talk about other asset classes.
I mean, you got soda hop. I mean, right? We mentioned dollar earlier, moving in, in theory, direction the bulls want to see. Rates moving in the direction bulls want to see. VIX moving in the direction bulls want to see.
Yeah, what do you mean by that?
Last time we were here on VIX, and the last time we got before 20 on VIX, it didn't last very long. That was the August highs. So we'll see what happens in the coming weeks with VIX there. But I mean, everything that bulls have kind of asked for, I feel like, is coming into play. Coming to fruition. Now we just need stocks to actually keep going higher.
Yeah, follow through. And what Ian's referencing there to the VIX, it's an index that's put out there by the CBOE, the Chicago Board of Exchange. And really it's a measurement, it's a real-time measurement, and represents like expectations of the relative near-term price changes in the S&P. And 19 on that index is not really something that we've seen for quite a bit. And the lower we go in the VIX, what it means is the increased likelihood. Typically, as you see the VIX drop, you see equities move higher. In general, that's a generality.
I think it's really the last two times we were here. We were here early April. Also, market top.
Well, that's just it. The lower highs that you're talking about have been coincident with about this level.
Mm-hmm. Yes. Yeah. Great way to put it.
And so we'll see. Are we going to go ahead and clear this level? And it's Ian, I know you've used on some of our internal calls, melt up type scenario where we just continue to see volatility cool off.
The possibility it's a non-zero.
Right. I don't know that we necessarily give that the highest likelihood. but it's an option that you would just continue, because we've seen it out of the Dow, right? When we look at the Dow Jones, it's the best performing index.
It is, and
out
it's
of the
held
group.
up. And I think as long as the Dow holds, so going back to, we talk about, the Dow's done now making lower highs, right?
Well, yeah, it's the first broad U.S. index that's cleared.
Index to get there. Is that foreshadowing, or is it just, it just happened to be the strongest and it got there?
Well,
right?
And we're
NASDAQ pretty far away still.
And it's so that the similarities to, because we're market historians, we like to look at the way markets and behave, right? Because it's good to observe behaviors from the past. When you go hunting, it's the same thing. You observe deer behavior, you observe wild turkey behavior. We can observe human behavior the same way. And
it's not like they change. It's not like one turkey's drastically different from the other.
Right. And so like you look at the Dow Jones back during another period where big cap tech corrected, and it was a hot mess that reclaimed the 200-day frequently, but moved basically sideways for years. And so are we in an environment like that? It's possible, but it is one index that's cleared its August high. The rest have not. With the exception of maybe we could say Europe.
DAX. The DAX had a big move on that same day. So November 10th is actually the day, the candle that put the DAX above its respective mid-August highs.
Good eye.
So it's been there. It's been there, clearly a relative leader, consolidating up here. Now it's kind of found itself in another big zone. We'll see if it can get through it. But Europe continues to be a relative leader for sure. I mean, you look at European financials, they got above November 11th. They broke above their August highs.
And that's probably a dollar story, right? Because
it's a great point.
The dollar peaked on a trade weighted basis September 28th, September 29th. That's when we see the low out of Europe. And so there's definitely a currency story here.
November 10th is when it kind of breaks its more intermediate term rate of uptrend.
And this is a key place for something like the euro versus the dollar.
November 10th sounds like a very important day.
Yeah. I would say
it's my birthday.
Right. And happy birthday to you. I'm sure you were ecstatic about that.
Oh, yeah. It was the best birthday ever. That 3% move at 8:30 in the morning.
Yeah. Before markets even open. And so, like, when you look at something like the euro versus the dollar, you're at this hugely important declining 50-day moving average. So I'm using euro versus USD. You're at the parity plus 5, so 1.05 level. This is a huge level. And you're seeing a lot of these levels appear. As far as like the trade weighted dollars approaching 103, 104.
Look at the euro coming in on a big spot.
Yeah, and the euro USD coming in on a big spot.
Back to pair. Well, now we're a nickel above, one spot 05.
Right.
But for all intents and purposes.
But that was a big breakdown. And is this a retest at polarity? And now we see Europe cool off. Or was that some major false breakdown and we continue to see the euro and Europe rip? No one knows. And that's the part that people need to keep in mind is you're gonna listen to CNBC and you're gonna listen to, and that's not a slam on CNBC. There's a million different financial news outlets out there, and they're all gonna tell you what they're all gonna predict. And they all predicted Sam Bankman-Fried was the next JP Morgan. And I'm here to break some bad news about news, and they're not great. They've got conflicts of interest, and it's not a great place to get your information.
I mean, he could be the next JP Morgan.
I don't know.
Is JP Morgan the cleanest
No.
Cleanest man who ever lived in the financial system? Probably not.
No. Nope. Not. That's a great point.
Okay, so I've got a question. How, and this is something that I go back and forth on. So we've had a question, or we've had a lot of conversations this year about the rising dollar and how that's been weighing on stocks. So what is the difference between, and people like to use, oh yeah, the dollar going up is bad for stocks. But I would say that narrative is I'd say it depends on a lot of other things.
Oh, for sure.
Because when you look at, 2002, right? I mean, during the .com crash, dollar was tanking. Really, during the mid 90s and the .com crash, it was tanking. Then you've got it moving higher for, basically 6 years up and from 02 to 08. We had a bull market then, if you want to call it. Well, we can get into that, whether that was a bull market or not.
So Ian, you're saying basically there's different dollar environments. And so sometimes it's tailwind, sometimes it's headwind, but it's not always what you expect. Is that?
Yeah, I don't think you can put, a blanket statement on the dollar is bad, or the dollar going up is bad, or the dollar going up is good for quote unquote stocks.
Right. These are generalities. These are, generally speaking, right? Because I think what you were pointing out is, like, for example, 1995 to 2000, the dollar is rising and so is the market. But you also have a scenario where the dollar's falling in 02 to 07 and the market's rising. So yes, it can be both. And so it's just a matter of when those things take place. And this goes back to take each chart on its own merit, I think is maybe a way to summarize what you're saying.
Mm-hmm.
Kind of somewhat related to that, people would say, okay, higher dollar means bonds are going up. What are we seeing out of the bond complex?
Rates rolling over. Bonds of all sizes moving to new highs. When you look at their futures, I think it was JC that had a great post yesterday or the day before showing 5, 10, and 30-year treasuries, I believe, all breaking to new highs. Yeah, 10-year. There's a nice little base on the 10-year note futures. If you look at ZN.
And typically what we see is the short end, or the, like a 2-year yield tends to lead a 10-year, which tends to lead a longer duration yield. And what's interesting about today is we're in a 2-year yield. Depending on how we close today, it could be a false breakdown in yields. And
could be
TBD. The 2-year yield being at above 4.28 would be important. That would be a potential failed breakdown. And so that would mean either rates stabilize or they move higher from here. But your point is valid based on the charts you're talking about. There's also evidence for bonds moving higher, which would mean rates move lower. And there's also a thesis out there for stocks and bonds move lower stocks and commodities move lower while bonds move higher.
And
that's still on the table.
Rolling over. Crude, the big one. We'll see. They bounced it at 76 back in September, and they've bounced it. A couple big ones late November on the 22nd, and then this past Monday, the 28th. But short term, can it get above 82? We'll see. Certainly, that's lower lows and lower highs. In essence, hasn't made any higher highs.
Right. Well, and what I find fascinating about, so there's a dogma or something that's pushed out there by the industry, which is, hey, as rates rise, the better off financials are.
Yeah. How about that? So, relative strength right there is telling you that maybe the stock market doesn't think rates are going to go lower.
Well, and you've got financials on a relative basis versus the S&P up into a range that's gone back to. So if you're a technician out there, or anybody who wants to look up a ratio chart, you take XLF, and I know you shared this, Ian, XLF versus the S&P. This goes back to 2020, 2021, and you now have financials rolling over on a relative basis versus the S&P. So,
yeah. And I wanted to correct myself. I guess maybe that would
match.
I said that would confirm that rates are going lower. The stocks seem to agree that rates going lower, and we know that banks move with rates, better spreads for their main line of business, which is loaning out money. So yeah, those weaker rates, it is. I think that's a great point you bring up. And regional banks, under the surface, regional banks themselves rolling over on a relative basis.
Super weak.
Yeah, I mean they're breaking their rate of trend, the relative uptrend that they've been in since early April, that first high. So almost the whole year, 6-7 months, they have outperformed the S&P, and that looks like it might be ending.
Right, and wouldn't that be something if European banks started to outperform American banks?
I mean, when you look at
you look at XLF versus EUFN, there's some telltale signs there. And that's not really a narrative right now. And I just love it when price does its thing first and then it becomes a narrative. But you're right that a rate environment that's falling at this point would mean potential weakness in financials, which we're seeing in actuality, in fact, versus the S&P 500. And so are we surprised after December if the Fed pivots? Price that the bond market is actually dictating what the Fed does. Everybody loves to talk about what the Fed's going to do and somehow that impacts everything. My argument is that the Fed responds, that it's not proactive. It doesn't set rates. It sets rates, but it's in response to the bond market. And wouldn't it be fascinating that at this point in time, it appears that bonds could be pointing to a rate cut or a pause in 2023 with I don't know if irony is the right word, but the warning sign that equities don't necessarily have the best time on the first rate pause or cut.
And that's the whole, when it uninverts.
Right. That you start to see an uninversion, right? Because we're heavily inverted right now in the yield curve. Yeah. Heavily inverted.
I mean, if you take 2s and 10s, it's up there.
Do you feel comfortable walking through that a little bit for someone who might not be,
never been. Going back to 89.
A 2-year yield versus a 10-year yield, which is a good measurement. That's what we're talking about.
Yes, you just divide one by the other. Obviously, if it's, the higher it's moving, that means you're getting paid more and more for
the shorter duration, right?
Shorter duration, right? And investors say, well, why would I take 30 years or why would I take 10 years of risk if I can take 2 years of risk and get paid the same amount?
Right. You can move to something that's.
And thus that ends, it's a kind of a vicious cycle in lending and I don't want to get on some big economic soapbox, but yeah, I mean, it's really hard for people to think long-term and for businesses and investors to go out, think long-term and take those risks, I think.
Well, yeah. And so, okay, if you're going to pay me 4% to buy a 30-year treasury that moves somewhat like a stock, but I can go buy a T-bill and get high twos, low threes, and there's no volatility. That's a huge like this is the most inverted we've seen the yield curve in a long, long time.
Okay, so think about this, Dave. So everyone's theories on yield curve inversion are based on the last 40 years, right?
Mm-hmm. That's a yield cycle.
So do you now see, okay, what if it happens, if we go into 40 years of rising rates, do you now have to view the yield cycle as it's going to get equal, like we get recessions when it inverts? Does that make
you mean the opposite? You're just saying the opposite.
Yeah, like the opposite. So like you could see these rates just continue to move higher. It doesn't cause a recession. But now when they get back to, and we'll have Pratty put this chart up, he'll know exactly what we're talking about. But if you take 2s versus 10s, you can see we're above this line of resistance here. I don't know if you've got that pulled up in front of you.
You got 2s versus 10s?
Yeah.
Yep. And my chart goes back to the late 80s.
Yeah, 89.
Yeah, so it's not a great, like I wish I could have this go back to the early 1900s.
Yeah, because I've never seen anyone show what yield curves really, or someone has shown it, but I haven't. It's another thing. I just wonder if that's now going to be that's a theory that's going to be broken because we're going to enter a rising rate environment for an extended period of time.
Right. Like a pre-82, right? So pre-82.
I mean, do we go through 10 years of 2-year rates are higher than 10-year rates?
Right. So the whole premise of this 2-year versus 10-year is it's just identifying that it's a risk off, it's a liquidity measurement, right? So if you're going to go to the short, if you're going to get more yield to be in short, like there's it, and that uninverts for the past 20, 30 years, that's been an environment where it uninverts. That's typically when we see recessions.
Yes.
Ian's point is, and I want to be careful because I'm about to say, is it different this time? Which is like, that's like, you hear that term and you're like, any market historian should cringe, right? Because is it different this time? The answer is no. But what was the environment pre-82? That 30 to 40 year period where you had a rising rate environment. Is this how, like, I think that's where you're going with this, Ian.
Yeah.
Is, in a rising rate environment, is it actually a different scenario? But we're about to find out because there's many economists, and I have no idea if anybody's listening to this who thinks this way, but when this uninverts, I mean, if we were to use the last 30 years, which why would we only use 30 years? Let's use all of the information. But if you only use the 30 years of information, you would say, wow, this is kind of signaling hard recession.
Very hard recession.
But that's TBD. We don't know. When you chalk up all the evidence of lower highs and lower lows, yes, we've rallied off the mid-October level in something like S&P 500. Yes, there are pockets of individual stocks that are doing well. At the same time, the big cap names that led us to this point for the past 12 years are not doing well. Financials are not doing well. And the dollar is at a pivotal point, just below its 200-day moving average, maybe holds 103, 104. Is this where we see somewhere in this spot, we see a resurgence in the dollar? And then you see things like risk on versus risk off, or risk off versus risk on, things like staples versus discretionary. And it's showing that we're not out of the woods yet.
Or, I mean, you can get a lower dollar too. And, yeah, it's a boost to U.S. stocks, but, right, I mean, if we go back to 02, 08, I mean, what outperformed?
Right.
Foreign.
Yeah. And that that could be what we're upon, is that we see that risk on is upon us. Foreign stocks are in favor. Value is in favor, right? That was the 03 to 08 environment, was energy, financials, materials, foreign. And maybe we just saw that initiate. I think it's too early to tell, but we're open to that thesis for sure. So we're kind of bumping up against the end of our time. Anything else you want to touch base on? It could be small, big, doesn't matter, before we wrap this up.
I would just say that we are, for all the people that have asked, we will, I think it's next week, we're doing the podcast episode on the ETF, correct?
Yeah, well, yeah, we'll do
that
a
will
special.
be out. And just, and I guess in regards to the market, it's, I mean, the evidence, we're in an intermediate term uptrend, right? That clearly, if you're in an uptrend, then the bulls are kind of in charge.
If I can clarify, I would say near term uptrend.
Yeah.
So on a daily time frame.
Yeah, and the last days, weeks, yeah.
But on an intermediate, which is weeks to months, we're in a downtrend. So near term uptrend, intermediate term downtrend. So like long term would be months to years. And
I would say, So for me, I would say definitely long term downtrend. Maybe my intermediate's a little bit more. I would just say over the last 6 weeks, we've been.
It's an uptrend. Yeah,
it's an uptrend. However you want to quantify that in your mind for listeners.
But I would just say it's a counter trend.
It's a counter trend. That's a great way to put it. From all we've seen, it's a counter trend move. This is really no different than August. In some ways, it's been stronger. In some ways, it's been weaker, but definitely not out of the woods yet. It's another thing, right, where by the time all the pieces do align, S&P is going to be at 5,000. So you cannot sit there and wait for, I don't know if waiting for the NASDAQ to get above its 200-day for confirmation is the appropriate thing to do. I mean, there's going to be lots of things, waiting for here's a great way to put it. I'm pretty sure that if this is over, waiting for the previous leaders to confirm that thesis would have you late to the game.
Right, because there's other market environments that we've studied where big cap growth has faltered while other stocks perform fine.
Yeah.
Hence 2000, 2003. So that thesis is still alive.
Those mega cap tech names definitely weighing on the market as far as they are not participating.
They're the same on a relative basis. The Qs versus the S&P is the same level it was March 19th, 2020.
But you can't sit there and say, I'm waiting for the Microsoft to get to new all-time highs to confirm that the stock market's moving higher. Yeah, right. You could have said that 5 years ago, and it probably would have beat the market to all-time highs because it was a relative leader. I just don't think that this time around. I mean, by the time I would be willing to bet, if let's say that we're done, we're in a new bull market. By the time Microsoft gets to new all-time highs, I would be willing to bet that the S&P is well through its all-time highs.
Right. Well, I mean, just using something like the NASDAQ would be a very quality example of 03 to 07. S&P reaches its prior high from 2000, while the NASDAQ is still 50% below its high from 2000.
Well, and you would talk about these previous leaders, and Mark Minervini did a great job talking about this on one of the videos that Pratty shared. Look at Amazon. So look how far this thing is away from its 200-day moving. So we're sitting here talking about the S&P got above its 200-day moving average on Wednesday.
Right.
Amazon's still 32% away. I mean, if you're waiting for that type of confirmation on these previous leaders, these mega large cap growth names, By the time that happens, S&P is going to be at 5,500.
Right. It's a massive rotation.
Mm-hmm.
If capital I, capital F, we are returning to a bull market. If big cap tech is going to do what it's doing right now, which is continue to lag.
Yeah, Amazon looks horrible.
It's going to be a massive rotation and take a lot of work by these other stocks. And so the headwind for this market remains. And that's what I want to be clear on is the big cap growth tech names, while they've rebounded since October, they haven't cleared any important hurdles yet from returning to leadership. So that's not the leadership group. In fact, that's the trash group. And that's where we've seen the biggest leadership. And that's where my hesitation is on calling for a return to a full bull market, is because these things led to the downside. They haven't reclaimed any important levels. And if they return to a downtrend, it's going to be problematic for this market. Yes, there will be individual stocks, pockets of them that we can take advantage of. Clients are familiar with those that are in their portfolios, but it's a major headwind to have growth tech, which are like 25 to 30% of something like the S&P 500's market cap. That's a huge headwind.
Well, and how about one of the worst sectors? You know what? The sector didn't have a great week. Energy.
Yeah, and that was a leader.
That was a leader, and it has stalled out for. We're going on a little over a month here. If you look at XLE, up at these highs from June at 93, 94-ish, somewhere up in there, 92-ish. So we'll see. And that's even with a pretty decent, some pretty decent bounces in crude. Now crude rolling over today. But crude's up. Crude had a 12% move from its highs to its low, 12% range this week. And energy stocks didn't, they didn't budge.
Right.
They're gonna finish the week down a couple percent. So yeah, maybe a change in narrative there. Maybe all commodity. Is this the commodity weakness part? Does oil weakness take energy weakness with it? Got to have crude break 78 first, but
so it's definitely not, to wrap things up. It's definitely not out of the woods for stocks as a whole. There are pockets of goodness, but there's definitely more confirmation that needs to come from the data coming in from price. Step one would be reclaiming some of these 200-day moving averages on something like the S&P and the Russell. NASDAQ's not even close. When we look on these things on a relative basis, still weak. When I say on a relative basis, really we're seeing strength out of equal weight things. So it's not big cap. You look at small caps and they're weak on a relative basis until today, but mid caps and up that aren't the mega cap names, that's probably where opportunity resides. We'll see what they do with bonds and with dollar in the weeks ahead. December is supposed to be seasonally bullish. If it's not, that's information too. November turned out to be, which is great. But with that, I just want to thank everybody for tuning in again after Thanksgiving. We hope everybody had a good Thanksgiving. Ian, anything else before we get out of here?
No.
Okay, awesome. Appreciate being on here with you again.
It's great.
And we'll do it again next week. And if you get a chance, if you're listening to this, you really appreciate it, you like the value that we provide, please give us a high ranking. It helps us get the word out.
Have a great weekend, everyone.